Good afternoon, everybody, and good morning to those in North America. About 11 months ago, my dear friend Dorian called me and told me the story about uranium, a big picture, and then about a company. And the stock was at 60, 70 cents then. And Dorian Prosdochemy has not only been right on a lot of things, but he's been very, very right on uranium. And it seemed such a strange call at the time, but it seemed to make sense. And more, I looked at it and other people looked at it, we realized that our great friend had found something very special. And a number of us invested, and we'd like to give you an update today. So Dorian, over to you.
Thanks, Rob. It's a great pleasure to reintroduce Scott Malby. But today we'll be speaking about Uranium Royalty Corp, which does have an association to Uranium Energy Corp. UEC owns 30% of URC, the royalty company. But before we go into the details, just to remind you who Scott is, he has so many titles. I'm just going to rattle through a few of them, otherwise we'll be here all day. But he's obviously the CEO of Uranium Royalty Corp. He was recently made the president of the Uranium Producers of America Association, I think that's what it's called. He's the former president of Cameco, and he's also the executive vice president of UEC. Welcome, Scott. And today we have some big news that you've announced with Cigar Lake and Macarthur River, which are two of the most prolific uranium mines in the world. And URC has a royalty agreement, which was announced today, which is massive news. So congratulations on that. But before we go into the details, do you want to give a sort of high-level overview of the story?
Sure, great. And thank you, Dorian and Rob. And as always, it's great to join your group wherever you're dialing in from around the world today. But yes, it's a very exciting story. I want to kind of dive into Uranium Royalty Corp as a way to be able to invest and capitalize on this whole green energy trend on a more macro global mega trend basis, but also in a commodity whose supply and demand fundamentals are probably at the best point they've been in 8 or 9 years. So we kind of have the collision of the mega trend with supply and demand fundamentals really driving uranium right now. A lot of investor interest, moving beyond the sort of usual investors into a broad generalist following now. So I think it's timely to really kind of unpack the macro picture just briefly, and then speak to Uranium Royalty and also talk a bit about our acquisition that we announced this morning. So the first starting point will really is around the narrative around. So I'm going to go ahead here. It's really the narrative around nuclear energy. Sorry, the narrative around nuclear energy. I mean, this is something in the uranium industry and nuclear energy industry. We've always known the strengths and benefits of nuclear energy in terms of large baseload power, clean energy, carbon-free energy, but it's really only been until recently where that carbon-free energy aspects of nuclear are beginning to be more widely accepted. It wasn't that long ago that you would have climate change meetings around the world where moving towards carbon-free energy, but nuclear wasn't invited to sit at the table. But I think you've had a lot of examples in recent years. You've seen the experience of Germany, of South Australia, of California. When you go into this heavy reliance on renewables and a carbon-free energy grid, but then you don't have a reliance on nuclear energy. And frankly, it's impossible today because we just don't have the ability to get 100% of our energy from wind and solar. But wind and solar in combination with nuclear can be and make huge strides towards carbon-free, or at least a lower carbon energy grid. Germany, I mentioned, was the great example. They went carbon-free without nuclear, and all that's resulted is them having electricity rates twice that of France, and carbon emissions 10 times that of nuclear France next door. With their weather recently, with solar panels not performing in the snowy, cloudy weather, and the wind not blowing, they're having to import record amounts of nuclear power from France and generate record amounts of electricity from lignite coal and natural gas from Russia. So it's really driving the story. We're seeing nuclear construction around the world extremely robust. We've had 53 new reactors come online around the world in the last 8 years, 52 more under construction, and a host of countries, I think over 30 countries now, are either using nuclear energy for electricity or planning to deploy it in the coming years. And this is not to mention the exciting inroads being made on small modular reactors, the smaller scalable reactors which can be built in remote locations or in a more scalable fashion and can more easily coexist on grids with intermittent renewables. So the demand story is amazing. The production side is obviously like any commodity that's been hit by low prices for the last 8 years or so. It's not surprising that production would finally start to fall off. And as the hedges fell off suppliers' portfolios, production started to drop in 2017. And we're now at a situation in 2021, demand globally for uranium is about 174 million pounds, production expected to come in at 135 million. So we've been at a 40, 50, 60 million pound gap from production to consumption for the last 3 years now. That's drawing on the secondary supplies and is going to really drive the price formation in the coming years. This shows it more graphically, the cuts to production that we have seen and are going to see in the uranium market globally. The gray bars are of note because those are mines that are just running out of resources and reserves and are playing out to the end of their mine life. So even without the near-term cuts due to economic low prices in the market, companies like Cameco, like mines in Africa, Australia, the United States, all cutting back production because of the low prices. You had COVID impact that dramatically last year and are continuing to impact production this year. You see the impact in the near term of those production cuts. So combination of mines phasing out over time, some very large mines around the world reaching the end of mine life, and these cuts are going to rebalance this uranium market quite dramatically and quickly. So the demand portfolio really sees the need for new production coming now, even closer as we sit in 2021, the need for new mines, even after the restarts of the world's largest mines in Saskatchewan, like Cigar Lake, like Macarthur River, after the restarts of mines in Kazakhstan, you still need additional new mine production. And that's not easy. It takes 8 to 10 years to permit a new mine. And some of these operations, if they're conventional mines, need very significant capital inflows to make that happen. So the narrative for uranium prices couldn't be better right now. Utilities have been kind of absent from the market for the last 7 or 8 years for a number of reasons. The bars on the right show the amount of contracting globally utilities have done each year. And you can see since 2013, it's been below sort of normal levels. If the world consumes about 170 to 180 million pounds a year, it should contract forward for at least that amount, or it's falling behind. Last year was even, an incredibly low year in terms of long-term contracting volume, but that's changing. The graph on the left shows what utilities need to buy and is yet not under contract. So this new cycle's coming. We're seeing an incredible supply crunch coming. It's not if, it's when, and it's much more imminent now as we sit today. So in the context of that, let's look at Uranium Royalty Corp. This is a company that was launched through an IPO on the TSX in December of 2019, so we're just a little over a year old. We really were amazed that in this day and age in base and precious metals, where the royalty and streaming companies like Franco-Nevada, Wheaton Precious Metals, Sandstorm, Royal Gold have become a $40 billion industry. They've become extremely attractive sources of alternative mine development finance, but they've also become a go-to investment for investors who want a pure play in a commodity, but they want diversified risk. So we took that model, brought it to uranium. We're the first mover in the space, and are deploying that in an industry that desperately needs, capital investment in the coming years. I mean, it could be $2 billion or more are needed to be invested in the next generation of mines globally in the uranium industry. We want to be there with royalties and streams. We have extremely strong balance sheet with $38 million in cash and listed securities. We're going to deploy some of that into our acquisition that I'll come to shortly. We have physical ownership in uranium. We were a foundational shareholder in Yellowcake PLC out of London, which is basically a company that buys, warehouses physical uranium and allows investors to speculate on the pure commodity. No mining risk, no political risk. It's uranium in the drum in the warehouses where the utilities buy that commodity. So we have a very significant stake in Yellowcake, 9% share. We have a very large and diversified portfolio that we launched with, and we've just added to significantly today. And expertise. We bring years, decades of experience in uranium. We're a company that is going to focus purely on uranium royalties. We're not interested in copper, nickel, gold, zinc. It's uranium. We understand the challenges that the uranium industry brings. Having done this for 36 years, I've seen the highs and lows and the cycles, but we also understand the opportunity. And just to mention a couple people in the team, Dave Newberger, Darcy Hurstborn. Darcy was 20 years with Cameco Corporation in global exploration. David Newberger ran, as VP of mining, ran the largest, highest grade mines in the world in Saskatchewan, mines that we've taken an interest in today. Amir Adnani is the entrepreneurial founder of the company, and the rest of the team, folks like Neil Gregson and Vina out of London and capital markets experience globally. So we have a very small team, which is typical of royalty and streaming companies, but very experienced. Doesn't take a lot of people to run a royalty company. One of the advantages is the G&A can be very low. We don't own the mines. We don't maintain the workforces. We just own financial interests in those operations. So as we sit today, 72 million shares outstanding. As of today, we were trading, I think, up as high as $2.43 a share, warrants at 73 cents. We launched a little over a year ago at $1.50 for a common share and a warrant, $1.50 for the two of those. Today, the share and warrant combined is over $3.16. So we've doubled in the last year from our IPO launch. Market cap is now close to about 175 million. Some of the key shareholders, we have sort of foundational shareholders, corporate shareholders that vended in assets, the largest being Uranium Energy Corp with a 19% ownership interest, vended in not only assets, but also sweat equity in terms of management support, back office support to get the company off the ground and launched. Altius, Mega vended in royalty assets into the mix. We have significant owners in the uranium space, folks like Marin Katuso, Rick Rule, and Sprott Global, Extract Capital, Darren Millmeister, Warren Gilman, folks like this that really understand the resource industry and are backing us with this uranium royalty model. As it stands today, we have 2 analysts covering us. I expect that will increase in the coming days and months, but Canaccord and H.C. Wainwright are doing research on the company presently. So the strategy is really quite simple. It's to build a diversified portfolio of royalties and streams. So either financial interests in future production or actual physical streams of uranium that we take from future production. We want to be across all the geographical jurisdictions for uranium. We want to have different range of counterparties, big, medium, small-sized companies, and various stages of development. A good royalty company has near-term exposure to cash flow and production, but also has investment in longer-term assets to build the future of the company. And across the cost curve, and of course the physical ownership, and I'll explain why we've done that. so early in the company's history. But again, we're only as good as the counterparties that we invest in, and these are the operators and counterparties of the royalties and streams we currently have in the portfolio. Companies like Cameco, Orano, Rio Tinto. We've got the Chinese, Paladin out of with their operations in Africa, EDF, and you see the rest of the names. So we really take a partnership view with these counterparties. We want to be partners in their success and can give some examples of how that works. But as we sit today, the portfolio quite diversified for a new company. We're quite proud of where we're at to date. We have assets in the United States, both conventional mining and in situ recovery. I think some of the in situ assets are some of the earliest movers in this next cycle, so we're quite pleased. We'd love to do more in that jurisdiction. We're very present in Canada, not only with Michelin in Newfoundland and Labrador, but in the Athabasca Basin, which is the premier uranium basin district in the world today. Interest in Langer Heinrich, the mine in Namibia, and we're very actively looking to add additional royalties. Let's just start with the announcement that we made earlier today. We announced the acquisition of 2 royalties in the Macarthur River and Cigar Lake mines in Saskatchewan. These are the world's largest, highest grade mines. This would be like a gold company getting a royalty on Grasberg or Carlin, or a copper royalty company getting Escondida. These are the cream of the crop. We have a gross overriding revenue on Macarthur River, which has been paying out and will provide consistent cash flows for us as soon as that mine restarts. We mentioned earlier that these mines, are shut down Macarthur for sort of market reasons. Cameco has been quite clear that this world-class asset deserves world-class contracts to support it. So they're quite content to keep it offline and draw down the secondary supplies to improve the uranium market in advance of that mine restarting, and which will begin to get royalties on as soon as that mine restarts. Cigar Lake is a little more complex with a net profit interest royalty. Has enormous upside, but it's still working through, as any NPI royalty would have, an expense account, which is being drawn down by current operations. We still have a couple more years to go on that, but when that expense account is drawn down, we have very significant 20% NPI that drops to 10% after 200 million pounds are produced, but has enormous upside in terms of uranium price, can also obviously accelerate when we start getting royalties under that asset. Upside in terms of production. These mines can potentially produce more than they have been in the past, and also extension. We've not given any credit in the valuation to date of, say, a phase 2 at Cigar Lake, which would extend the mine life. But that's a decision. It's not ours to make. It's for Cameco and Orano. And with these assets, I would encourage you, to look at the guidance there and see when they intend to restart this. Cigar Lake is shut in for really COVID reasons. So I think it's viewed to be much more shorter term impact. As soon as COVID is brought under control in Saskatchewan, that mine will restart. It may restart in phases over the next 12 months. Macarthur, again, as soon as they start getting contracts that support that mine, they'll restart there. And in a conference call yesterday, Cameco did describe to investors that those off-market discussions with very large global utilities and state-owned utilities has already begun. So we're optimistic that Macarthur and Cigar are really amongst the earliest mines to restart in this uranium recovery. This builds on royalties that we have in the basin. We have Rough Rider, which is a future mine development. It's an example of a mine that will be built towards the end of the decade or early into the next decade, but it will be a replacement of productive capacity that goes off, perhaps Cigar Lake phasing out over time. Rough Rider will come on. It's not going to cash flow in this next cycle, but it's something that will really crystallize value as we move through the decade and new mine developments come on in Saskatchewan. The Yellowcake investment is something that gives early investors in uranium royalty exposure to very cheap uranium. We were a foundational shareholder in Yellowcake's IPO close to 3 years ago. When we invested and bought about 9% interest of this company, it gave us exposure to about $20, $21 uranium, and we're now in a $30 market. So early on, until we start to get those steady cash flows that will come in, like we'll get from a Langer Heinrich or a Macarthur River, this will provide capital gains, if you will, on the holdings of uranium held in the portfolio. So we're quite happy to have that. It also gives us strategic relationship with Yellowcake and their partner Kazatomprom, the world's largest producer presently. We're able to access up to $31 million US of physical uranium purchases directly from Kazatomprom as part of the Yellowcake supply agreement. So again, a nice asset to have in the mix. Again, we mentioned Macarthur River has produced 18 million pounds a year. It is the world's largest mine to date. Has produced 325 million pounds since it went into production in 1999. It has another 23, 24 years of operations, if not more, if additional resources are discovered in and around this operation. Cigar Lake, again, is also produced at the 18 million pound level. Combined, Cigar and Macarthur, they do have regulatory approval to go up to as high as 43 million. So keep in mind that there is upside in terms of the production here. This is a joint venture between Cameco Orano and Japanese company Idemitsu and TEPCO, the utility out of Tokyo. So again, to have exposure to these world-class assets is something that really gives us near-term cash flows when Macarthur restarts operations, and also gives us steady long-term revenue over time. The US ISR, again, we think in situ uranium mining, very low capital. It's a very environmentally friendly way to mine sandstone-hosted ore bodies. In the United States, I think the most competitive mines are going to be ISR. They can compete in the lower half of production cost quartiles. So again, we're quite pleased to be involved in some of the names that are going to be the early movers, including UEC's Reno Creek, Azarga's Dewey Burdock, and Peninsula's Lance. Globally, beyond North America, we have the Langer Heinrich mine, which has been producing several million pounds a year for a number of years. It's also in temporary standby because of the low uranium price, but we think it's one of the early movers. They've gone through a very extensive cost efficiency exercise to lower the production cost at Langer Heinrich. We have a fixed royalty in this operation that we're thrilled to be associated with this company. And this is a company, again, where we view, we can partner with these companies and really be an value-added partner in their activities. We're not just a bank that has a financial interest. I have gone down and sat with Langer Heinrich's board and management and been able to share experience over my 36 years at Cameco, Kazatomprom, at Uranium One, some of the challenges on uranium marketing, and kind of feed into their restart decisions. So we really want to come alongside them and be part of their success. And then conventional assets are probably not in the first tier of production costs, but these come into production quite quickly as uranium prices rise and feed the conventional mill capacity in the Colorado Plateau. So again, holdings that we're really pleased to have. So with that, I think I'll leave the rest of the time, Rob and Dorian, to kind of open it up to questions and discussions, if you think that's the best approach.
Sure.
Yep, that's perfect. Dorian, do you want to summarize and then we'll have questions?
Yeah, so I think what's interesting about this story, just to, we have a lot of people on this group that have owned Uranium Energy Corp, including Rob and myself. And what's very interesting about this is, I mean, first of all, for the UEC holders, by virtue of owning Uranium Energy Corp, as I said before, you own 30% of Uranium Royalty Corp. But what is so interesting about this story and makes it so unique, in my opinion, is that it's effectively a very interesting ecosystem which is unique to the uranium space, in that you have Uranium Energy Corp as a US-based domestic producer with all the political advantages that are coming its way. They in turn have an ownership in URC, the royalty company, who in turn has a 10% or 9% holding of Yellowcake, which has access to physical uranium and the cheapest physical uranium from Kazatomprom in Kazakhstan. So it's actually it's very unique. But I'll just kick it off with one question, which is a question that I get very often, and I think people get a little bit confused. So today you announced this news with Macarthur River and Cigar Lake, and some people are wondering why Cameco didn't do a press release. Can you just clarify why that's the case, and how you managed to get this royalty? Because I think it will give some perspective.
Yeah, it's the acquisition of these royalties is quite unique. The royalty interests are on the Orano portion of the ore bodies and the operations, and they stem all the way back to the original discovery of the deposits, going back to the late 70s and early 80s, where a company known as Reserve Oil and Minerals went into the Athabasca Basin, as many oil companies, Shell, Gulf Minerals, everybody were up in the basin exploring for uranium. Reserve was part of the early discoveries here in these deposits, and through time sold their interests, retained royalties, and those interests eventually ended up in Orano's hands. So we acquired these royalty interests directly from Reserve Minerals, Reserve Oil and Minerals, out of Albuquerque, New Mexico. So it's kind of a unique way, and I think it shows that we're really overturning stones everywhere we can around the world to find these royalty interests. These were not big royalties that were sitting out there for everyone to see, in Cameco or Orano. They were in a company out of Albuquerque, New Mexico. So the acquisition price was 11.5 million US, 1.5 million of that in URC shares. So we get them as a significant shareholder, and I'm thrilled to have them. But really, it's exciting. These royalties go back to the very genesis of the Cigar Lake and Macarthur River deposits. But in terms of Cameco and Orano, I think it's important as investors kind of look at this and say, okay, well, when we're asked, when are the mines going to restart? Exactly, is it going to be later this year, next year? It's really not us to say. It's really a decision of Cameco and Orano, and they are quite transparent and open in giving guidance quarterly, on a quarterly basis, as to what the status of those operations are. So you can get a good feel for when the mines will restart, and we'll start to see revenue under these royalties if you follow closely with Orano and Cameco's.
Scott, can I ask a macro question? The incoming Biden presidency and cabinet, are they supportive to uranium? Have they played the cards yet? Have they indicated where they stand on this?
Yeah, well, it's we're actually quite excited. I mean, coming off of the Trump administration, and really any Republican administration in the United States is going to adhere to an all-of-the-above energy policy. So that means reliance on coal, gas, oil, nuclear, wind, and solar. So we were a part of that mix, and we always have received strong support from Republican administrations. Now enter the Biden administration, which is putting a very high priority. On day one, they re-signed the United States into the Paris Climate Accord and basically shut down the Keystone XL pipeline. So if that's any indication of where the Biden administration, how they feel about fossil fuels, it speaks very well for nuclear. They have in the Democratic platform for the first time in decades named nuclear as an important part of their carbon-free strategies. And we know just from physics and math and science that renewables can't get us 100% of our needs. Something that runs 30% of the time can't give us 100% of our energy. So if we don't continue to rely on nuclear power in the United States, it's 55% of our carbon-free energy, even though it's only 20% not only, that's a lot, 20% of our electricity supplies. So the Biden administration has said they want to rely on the existing fleet, and there's been significant successes there in upgrades of existing reactors, license extensions. There's been some reactors in the United States that have been threatened by early shutdown because of, I would say, more market structure. Very tough to compete against subsidized wind and solar, even though you're the one that's delivering the most.
The subsidies will be lifted pretty soon, I would think.
Well, yeah, I think the subsidies will continue on wind and solar. I think you're going to just see whether it's subsidies or giving nuclear energy the clean air credits that allow it to compete with subsidized wind and solar. I mean, if it was my country, I would drop all the subsidies and nuclear would do just fine. But I think it's more likely that the support continues to be put behind wind and solar and now nuclear energy. So I just assume the presidency of Uranium Producers of America. So I have a wonderful opportunity to really engage this new administration. And listen, I'm sure there's still some within the administration that haven't gotten the memo yet that nuclear is part of the solution and we're the good guys. But that's our job to convince them. And also, we need them to love the mining as much as they love the clean air energy. So we'll be educating folks on the Hill and in the administration on how clean and green in situ mining is in the United States and can be a real, the energy intensity of uranium is, the energy density is the highest of any energy source. So we don't have a big footprint and we can provide a lot of carbon-free energy.
Scott, Dorian, if you don't mind, I'm going to throw in Hugo Kruger's question from the audience. He says, do you see a future market for thorium?
Yeah, so thorium is interesting. The best education I got on thorium was from the former commissioner of the Nuclear Regulatory Commission in the United States, where I spent an entire day in a car driving across Wyoming and touring, at that time, Cameco's uranium mines. And he had just returned from India, which is the most advanced in the thorium fuel cycle to generate electricity. Why did India go down that path? Because they were barred from mining uranium or barred from using nuclear energy because of the weapons tests they conducted in the 70s. So they were forced to utilize their indigenous sources of thorium. They started that back in the 70s and early 80s, and they're still, according to the NRC commissioner, still decades away from making that fuel cycle really effective. So listen, 100 years from now, I think we're going to be looking for every source of energy that we possibly can on this planet, but I don't see it displacing the uranium fuel cycle in the near term. And in India, you see the current fleet of new reactors being built there are the light water reactors or pressurized heavy water reactors using the uranium fuel cycle. And in China, obviously, all the growth there, the 50 units that are in operation now, and China will be the largest nuclear power market in 5 to 10 years from now. So very exciting, but very much in the uranium fuel cycle. So thorium is a future source of energy, but not in the immediate term.
Scott, a question that I get very often, and I'm wondering if you could help me sort of answer it, but it's an interesting one. So when you look at the market cap of Tesla as an example, which is almost $1 trillion now, and then you look at the market cap of all the uranium producers that are listed around the world, and I think the collective market cap is sub 20 billion. And yet uranium via nuclear generates, I believe, about 10–11% of the world's electricity. So it just gives you a real sense of how forgotten and undervalued this this sector is.
Yeah, no, it really is. An electric vehicles are a huge driver for the uranium story. I mean, you mentioned the Biden administration, the new Secretary of Energy, Granholm, it comes from Michigan and is very much in tune with the auto industry. She's a big proponent of electric vehicles. And, let's face it, if, in the United States, we're, yes, we're getting 55% of our carbon-free energy from nuclear, but in many regions, we're still getting 60, 70% of our electricity from coal. You defeat the whole purpose of the electric vehicle. And so, not only is the world shifting and trending towards carbon-free energy, but they're trending towards electric vehicles, which in Elon Musk's words will double global electricity demand, and I think that's realistic. But if we're just filling our electric vehicles with coal-fired electricity, we can call them lignite cars, not clean cars. So I think it's a real driver for our story, and you're seeing a lot of the tech titans and leaders like Bill Gates, Peter Thiel, really recognizing this dynamic, and they've done the math and science, and they're saying if we're going to have carbon-free or lower carbon future, and we are going to be able to power an ever more electrified society, especially with electric vehicles and trucks, cars, we're going to need to generate more electricity from nuclear power. So we're a great partner to renewables. We can help them fit into the grid better, and we're also a great supplier of electricity to the EV revolution that's underway.
Scott, I'm going to ask you a very unfair question, but I know a few people will giggle at the thought of you answering this. So, if we gave you a choice of buying UEC or URC, which one would you buy?
That's like, I have 3 kids, and that's like asking me which one of my kids I like better. It's a tough one, but the easy cop out on that is to own them both. I mean, UEC gives you that direct leverage to a near-term producer developer in a great jurisdiction, low cost, scalable, and great political support now with the new administration. So you're going to get a lot of torque on that investment, but it's a very focused investment, just like it would be in any uranium equity. Uranium royalty gives you interests in numerous operations across the globe, and we're going to continue to add to that portfolio like we did today. So, I think it's interesting in gold and precious metals. You would think that, the spectrum can be the pure uranium mining equities, junior or senior. You'd have the royalty companies, and then you'd have the physical commodity ETFs. And you'd think the royalty companies would be somewhere in between in terms of the risk-return risk-reward ratio, but we've actually seen the royalty companies outperform the equity companies, in recent years because of the advantages they bring. You're trading at a premium to NAV and acquire assets at discount to NAV. That's the magic sauce in the royalty business. But again, I think I would have both of those companies in my uranium portfolio, but they both kind of provide a little different approach to the market.
That's fantastic, Scott. And if I may, I'm just going to ask one last technical question, which I've got on my WhatsApp. So with regards to the contract, with the royalty stream that you've announced today with on Cigar Lake and Macarthur River, I believe you can choose whether to take material in kind as opposed to cash from the revenue stream, depending, because obviously they'll get one price that they've agreed with their on their long-term contracts. But if that price is lower than the prevailing spot price at the time, I believe you can take the payment in actual physical uranium. Is that right?
Yeah, that's an important aspect, and no one has a keener appreciation of this than me, having sold millions of, billions of dollars worth of uranium from these 2 mines during my 23 years at Cameco. The legacy contracts obviously, when you contract at a peak of the market, and you have long-term contracts that are delivering prices well above the spot price, you prefer to rely on the contract price. But in periods where uranium price may be going from a very low place and increasing rapidly, it may be more advantageous to take the spot price than the average term price that Orano may be selling into under these contracts. So the beauty of this, at least under the Macarthur River royalty, is that we can elect to take physical delivery of uranium to our account in Ontario, Canada, and realize the full market value. So if uranium price was going from 40 to 50 to 60, we would probably elect that and take the physical. But at other times, we would rely on the actual selling price that the partners in those projects are selling to utilities.
Great. Scott, I think we're going to wrap it up there. I'll just make one last comment that Bitcoin mining does help the consumption of electricity. So keep mining, guys. But anyway, Scott, listen, great presentation. Good to reconnect, and hopefully we can do this in the future. Rob, over to you.
And well done, Dorian. I'm a very happy investor, and if anyone wants the recording of this, we can make it available. But thank you again to Lauren and Jeffrey for putting this on. And Scott, well done.
Thanks, guys. And I will make the slides available to Dorian or Lauren to distribute if you want to get those. But again, appreciate everybody's time today. The uranium story is pretty exciting, so we're glad to be positioned right where we need to be, in right industry and the right models. So thank you, guys.
Thank you, Scott. Thank you, Dorian. Thank you, everybody.
Thanks, guys.
Bye.